All right, I'm going to try to pick up the pace a little bit to get to the numbers. There's not a lot of number crunching in this chapter, so let's, this is a lot about understanding what internal controls are, risks, and so on. So let's talk about risks. It depends on what your company is as to what your risks are, right? Every company is going to have its own risks. So like for banks, for example, their risks are, the cash, obviously, right? Making good credit decisions. You don't want to give credit to bad people, people that can't pay it back. You want to make good investment decisions. It's not just about, stealing. It's about safeguarding your assets. So making sure that you are making wise decisions for the business. If you say we're a pharmaceutical company, your risks would be something like quality, right? You don't want anybody getting sick. You want to make sure you're producing a good product. So it's, like I said, it's not just about cash or anything or protecting your actual physical assets. It's about making sure that your assets overall, your important things that are important to your company, are safeguarded. If you're in a warehouse, you're concerned about the safety, you're concerned about theft, you're concerned about things like damage. If you're in the purchasing department of a business, your risk area would be, it would be like making sure that nobody's getting kickbacks, right? And let me explain what a kickback is. You may have heard the term, so I just want to kind of give you a little explanation. Let's say you've got a company, and in that company, you have a purchasing agent, and that purchasing agent's job is to buy products. Well, let's say the purchasing agent is going to buy from someone that maybe they shouldn't buy from, right? They're engaged in some sort of scheme. So let's say that they're buying something that has a $10 market value, but they're saying, oh, this is the cost, it's $16. So they tell their company the cost is $16. The company pays that cost because it's the purchasing agent's job to determine the best costs. So they pay the $16, right, for something that's only $10 market value. The supplier is like, yay, we're getting an extra $6. But then they're turning around and maybe giving 3 of that back to the purchasing agent. So the purchasing agent is actually getting what's called a kickback from the supplier, right? They're splitting the $6 that they're making on every one of these sales, and who's getting beat? The company's getting beat. All right, so the idea there is you want to make sure your purchasing agents are separate from your suppliers. Maybe you make it that, over a certain dollar amount, they have to get reviewed. Or you make it so that the purchasing agent is not allowed to have a personal relationship with the supplier. Lots of times the suppliers want to get used, so they might throw some sports tickets at a purchasing agent. Or go out to drink. Let's have drinks, right? Something like that. Purchasing agents should be forbidden from, meeting with suppliers for that reason. Sad but true. Okay. Separation of duties. We did talk about this a bit in the last chapter, or 2 chapters ago, when we talked about separating the pieces of purchasing. So let's say you had a purchase order, right? The purchase order goes to a vendor. The vendor sends the merchandise to the receiving department, right? Most businesses have receiving departments. Truck backs up. You get a piece of paper. That's your receiving report, and your receiving people would say, yes, we did in fact receive the items. The bill then goes to the accounts payable, and the idea is that these 3 pieces must match. The original purchase order must match the receipt, what we agreed to purchase, and the price we agreed to pay must match the fact that we actually did get the product, must match the invoice. All right, it's a 3-way match. That is a great internal control. Because if any of these pieces don't match, the bill doesn't get paid, right? So the idea is you're trying to separate the items. You're separating the duties. You're separating purchasing from receiving from paying. And really what that comes down to is with accounting, you're separating the person who's doing the accounting, the actual numbers, from the person who has their hands on the inventory or the assets, separate from the person who's running, who's doing the operations of the business. So you're separating the core components. When you start mixing these things, you wind up with problems. If you have one person doing any of these 2 things, you're not safeguarding your assets. They can get away with more than you want them to. Let's give you a couple of simple examples. Let's say you have a salesperson who is being paid on a commission basis, right? That means they make money with every sale, is also responsible for granting credit. Well, the commission basis is a problem, right? Because they make money on every sale. So what are they going to do? They are going to grant credit to people who maybe don't deserve it just so they get the sale. So maybe somebody's got really bad credit, but they're still going to sell the product to them because they get paid based on the number of products they sell. right? So there's your problem. You've got these two pieces together. You get the person's, well, sorry. All right. You've got these two pieces together that are causing a problem. Purchasing agent orders supplies, inspects supplies to verify the correct items were received, and authorize payment of a vendor's invoice. You've got somebody in charge of all three pieces here. All right, and the problem with that, who's to say they don't purchase things that then they stick in their pocket and, they say they received, but they weren't really received, and, so on. Or that they pay more than they should pay. I mean, there's just games that can be played here. Another worker in a donut shop takes a customer's order, packs his or her donuts in a bag, the box, rings the money on order and cash register, and takes the customer's money. Same thing. What's stopping anybody from doing these things separately? From just taking the order, giving the donut, and putting the cash in the pocket. There's nothing preventing that. Okay, so the recording, though, is being set separately from the asset in, like, inventory assets. Okay. How do you keep these things separate, right? You're like, how do you, what if you got a small donut shop? How do you keep these things separate? How do you prevent somebody from pocketing just the order, the cash from the order? Well, depending on the size of the business, there are controls you can put into place. I'll give you an example. QuickChek, right? QuickChek, little convenience store in New Jersey. They have it separate. They have figured out a way. If you think about it, you order on screen, which my children love to do. You order on screen. You get an order slip. You then go pay for the order slip, right? The order slip gets generated, right? The customer then takes it to go pay, and the person has to go prepare. Person in the sub area has to then go make the sandwich. You pay at the register, and then you pick up the sub with receipt. You have separated all the components, right? The person getting the cash is separate than the person with the assets. That's separate than the customer, right? All those pieces are done individually. So the idea is that there's lots of things that you don't even think about that are internal controls. Registers are really good internal controls because you're forced to input something into a register. I don't know if you've ever seen some places have like a sign on them that says, if you don't get a receipt, your meal is free, right? So I don't know if you, like, last time I've seen this, I think it was on the Parkway, the Jersey Shore Parkway. You go up to the register and it says, a little sign says, if you don't get a receipt, then this meal is free. And the reason that's there like that is because it's forcing the person behind the cash register to key in that hamburger I just ordered. And then if it's keyed into the system, it gets recorded because otherwise a receipt is not going to generate, right? So what that is preventing is me giving that person $5 and then sticking in their pocket and then giving me a hamburger and not recording the sale in the register at all because I'm looking for my receipt. That's an internal control. So there's lots of little internal controls you can put into play. And the places you see these that are the weakest are the small moms and pops just because they don't have the knowledge or the money or the manpower to separate these processes. So it's something that's really important, though, especially for those small mom and pops. Okay. All right. I'm not going to talk so much about the lapping scheme. All right, we'll do it real quick. A typical, you can read these on your own. A typical scheme for accounts receivable is that, let's say, or here, I'll go back. Let's say you have an accounts receivable, right? The person collecting the money takes that that money, and they decide they're not going to apply it against accounts receivable, right? Somebody goes to pay a bill, and the person collecting accounts receivable has the money, and they decide they put the money in their pocket. For whatever reason, they can do that, right? Cash, whatever. Put the money in their pocket. Well, what's going to happen? A bill's going to be sent to that person, and it's going to say, you didn't pay us. Where's your money? And they're going to get caught. The person who stole the money for the receivable from the company is going to get caught. So what that person from the company is going to do is they're going to take that receivable, and they're going to take that cash, and they're going to put it in their pocket. All right, so here we go. First accounts receivable, payment gets sent in, and it gets stolen, right? The accounts receivable person has taken the money. Well, the way they're going to cover their tracks is, let's say the second accounts receivable comes in, right? So a second person then sends payment. Person number two's payment then gets applied to person number one's outstanding receivable. So what happens here? Accounts receivable number one looks like it was paid. I still have the money in my pocket because I stole it. And now you've got this person who's got unpaid bills, an unpaid receivable out there. Well, okay, so fine. So accounts receivable person number three sends her bill in, sends her cash in, and we apply the accounts receivable number 3, the cash that comes in from number 3, to person number 2. So the idea is each person's next payment then gets recorded as the previous person's payment. That means there's going to be money, it's going to be a little bit of balancing in there too. Yeah, because different amounts. But the idea is that each previous payment covers the next payment. Well, that can go on like forever. But if you got away with it once, you're probably going to get away with it twice, 3 times, 4 times. You're going to keep stealing, right, as the payments come along. And the problem there is that you can't miss a day of work. If I was the one stealing and I was using the next person to always cover the previous person, or if I'm like several $1,000s in because I've been stealing money all the way along and continuing to pay it forward, nobody's going to know unless I take a day off or I get sick or something like that, and somebody else has to do my job. Because if somebody else is doing my job, they're going to apply the receivables that they received in the right places, and they're going to leave a whole bunch of the older receivables unpaid. So you know how you have like people come in and say, oh, Bessie is the best employee ever. She's never taken a day off. She's our accounts receivable person. As an auditor, that's a red flag, because Bessie is probably got something going on like this where she could be stealing and stealing and stealing, and she can't take a day off. All right, I want to say it was, I could be wrong, but I want to say it was Duke University that had this happen, and it wasn't all that long ago, maybe 20 years ago. Okay, I said not long ago, but I guess it really was. Maybe like 20 years ago. And the woman had like $1 million, like had stolen $1 million over a bunch of years, over the 20 years she worked there or something. And this is what she was doing. Okay, so it's totally a normal accounts receivable scheme. Another major place there are schemes, payroll. Payroll's huge. Putting in fictitious employees, not firing employees, but still collecting their paychecks. Payroll's got lots of places and it needs lots of internal controls. Okay, I'm not going to go through the second one just because I hope you get the idea. I need to get on to like the real stuff, the math here. Okay, so, all right. I'll hit these and then we'll go on to the next one. The idea of other internal controls are audits. Audits are internal controls, right? External audits, financial statements, internal control, internal auditors. Lots of companies have internal auditors. That's what they do. They act like external auditors, but from the inside, to kind of make sure there's nothing funky going on within their business itself. How do you, if you have documents, let's say you've got purchase orders, things like that, best thing to do, make sure they're numbered, right? So that you can keep track of them, so that every one is accounted for. If you have electronic devices, you put sensors on your assets, right? That's an internal control. If you're involved in e-commerce, right? Firewalls, encryption, right? Blockchain, things like that. Those are all internal controls, or can be used as internal controls. Miscellaneous things like making sure you've got alarms, cameras, security, cross-train your employees, because person A might be bad, person B may not be bad, and person B knows that what person A is doing is not right if they don't know that unless they know each other's job. Or they swap jobs. One last thing about that. Interestingly, if you work in the financial industries, you're forced to take mandatory vacations consecutively, like 2 weeks of mandatory vacation, specifically for the purpose of catching any of these schemes that will fall apart, like the lapping one, if you're away. Kind of interesting, right? All right, onward we go. Okay, we're not going to go through this. The idea is that cash registers are good internal controls, and I already explained why. We're going to go on to number 3, and I promise I'll get to numbers.